So we are going to begin our revision as we have said, done when it comes to class. And, we are going to start from the last sitting. That's where we are going to begin our revision. I think that is the paper of September 2021. September 2021. So we begin with question 1. Question 1. Question 1A. Question 1A says, explain the term responsibility accounting. Explain the term responsibility accounting. Responsibility accounting. This is part of what we have been talking about in performance measurement. But for revision purposes, you can write the following. You can write the following. Responsibility accounting is a system of management accounting. Is a system of management accounting under which accountability is established. Under which accountability is established according to the responsibility delegated. According to the responsibility delegated to various levels of management. To various levels of management. And a management information. And a management information. And reporting system. And reporting system. Reporting system instituted to give adequate feedback. To give adequate feedback in terms of the delegated responsibility. In terms of the delegated responsibility. So that is what we call responsibility accounting. It is what we call performance measurement. And as you can see, it is saying it is a method of management accounting under which accountability is established. Accountability has to do with being called upon to give account or to give details of what is it that you did. And it is based on what we call delegated authorities or delegated duties. And there should be a management information and reporting system that will provide feedback. Like what I told you the other day when I brought you the information forms, that is a management system that is able to take back the information to the managers, saying whether what I'm doing here or what is happening here is what should be happening. So that is one of the definitions you can give. You can also adopt the one that I gave you in the notes, where we say performance measurement is simply an exercise of comparing the expected performance and the actual performance. That is basically what you could say. Let's go to part B. Examine for advantages of responsibility accounting. Part B, you're told to examine advantages of responsibility accounting. Responsibility accounting. If you remember what I told you is that the primary purpose as to why we do performance measurement is, number one, for the owners of the company to be sure that their original goal is being pursued. And number two, to get a basis upon which someone will be punished or someone will be rewarded. So you could argue from that perspective, but for our purposes now here, we can put the following. Number one, it urges the management to acknowledge company structure, and checks who is accountable for what. And checks who is accountable for what. Who is accountable for what. And fix the problems. And fix the problem. So that is basically what we say. One, you're able to know the structure. Structure has to do with how the company is organized, who is doing what. And I told you we have 4 types of responsibility centers. We have the cost, we have the revenue, we have the profit, and we have the investment. So we are able to know the structure. And in this structure, we are able to know who is in charge of costs, who is in charge of revenues, who is in charge of profits, who is in charge of investments. Or even, depending on the specific needs of the company, you could also create some other responsibility centers. Like in a school like this one, we could be having a responsibility centers of who is in charge of the students' enrollment. How many students are in this school? Then who is in charge of fees collected? Nani, if we want to know how much has been collected or how much has not been collected, who do we ask? Then who is in charge of syllabus coverage? Then again, we go asking that. Then who is in charge of cleanliness of the school? Those are very many issues or very many functions of the organization around which you could create the responsibility centers. Number 2, it enhances attention and awareness. Enhances attention and awareness of the managers, as they have to explain, the variations for which variations for which they are responsible. The variations for which they are responsible. So what that means is, when you know that you'll be called upon to explain, you become more careful. As opposed to where you know no one will come later on to ask you any question. But when you know this one I will be called upon to explain, then you become more aware, you become more careful, you become more conscious. And overall, that without saying, it means that the performance will be good, because no one will want to be called upon to explain poor performance. Number 3, helps to compare achievements between pre-planned goals, and actual results. Goals and actual results. Remember, our definition that we have been running with was, it is an exercise where we compare the expected and the actual. So when we compare, we are able to get the variances. So the method helps us to compare the pre-planned and the actual results. Another one is that it creates a sense of efficiency. It creates a sense of efficiency. It creates a sense of efficiency. Another one is that it guides management planning. It guides management planning. Guides management planning. Another one is that it enhances cost control. Enhances cost control. So I think those are good enough. Those are good enough. Good. So we go to part B of the question. Part B of the question says, or rather part C. Part C, the division managers of Residual Limited, a medium-sized company, are usually evaluated, and those with outstanding performance rewarded on an annual basis. The division manager of KT division is faced with the following mutually exclusive investments. So we have project A and project B, initial capital outlay, and we have those amounts. So we have the additional information. I think we can just proceed as usual. So we are drawing performance measurements statements, performance measurement statements, and in doing this, we have details. Then we have the year 2022, project A, and project B, 2023, project A and B, 2024, project A and B, 2025, project A and B. Project A and B. Okay, so now opening value. Now this opening value, in the question that we had in class, we called it A, but now you see here that it's project A and B. Eh? So to avoid confusion, we can call it C. So for the first project, we have 8,000. Make our figures are in thousands. And then we have 8120. So the next thing is to get the depreciation. which now we can call D. We call D, and according to information 6, we are told that both projects A and B are expected to have nil residual value. Expected to have both residual value. So we divide by 4. So this one, when you divide by 4, you get what? 2,000. And the other one, 2030. 2030. So the closing value, now closing value will be arrived at as C minus D. So this one is what? 6,000. The other one is 1690. So we go to the second year where we have 6,000. We left 2,000. We are left with 4,000. Then 1690, you less 2030. 4060. Then this one is 4,000. 2,000. We are left with 2,000. So 4060. And then 2030, we have 2030. So this is 2,000. 2,000 here, 0. 2030, 2030, and we are left with 0. From there, let's get the cost of capital. Cost of capital. Cost of capital, according to information 3, is 18%. So it will be 0.18 of C, and we call it E. We call it E. So take your calc. Give me the figures. 18% of 8,000. 1440. 18% of 8120. 1461.6. 18% of 6,000. 1080. 18% of 60. You have 1096.2. 18% of 4,000. 720. 730.8. 360. 365.4. Okay. Now we can bring the net cash flow. Net cash flow, which we will call F. Net cash flow, which we will call F. We say this one we just copy as it is given in the question there. The first one we are given 36, 20, then 42.60 for the first project. Then this is 36.20, 35.80. Then we have 36.20, 26.40, 36.20, 2100. So now from there we get the income. Income is going to be given as the cash flow minus the depreciation D, and we call it G. We call it G. So to answer the first one, that is 620 minus 2000, you have what? 1620. Then 2230, 1620, 1550, 1620, 610, 1620, and then we have what? 70. All right. Then we have residual income. Residual income. And residual income, we say it is given as the income, which is G, minus the cost of capital, which we call E. And this gives us H. So 1620 minus 1440, you get what? 180. $768.4. 540. 453.8. 900. Negative 120.8. 12. Then this other one is what? Negative 295.4. So the last one is return on investment. Return on investment. And return on investment will be the income G. You divide by the opening value C. You multiply by 100. Multiply by 100. Two points. 2.25%. Getting 20. Yes, Christine, welcome. Is it confirmed? We are taking this one. G, it is 1620. You divide by 8,000. It is 20.25. 20.25. Hiyo ingine ni 0.46%. 27%. 25.45%. 40.5%. 15.02%. 81%. 3.45. 3.45%. 3.45%. So now from there, we need to compute the average. Yeah, okay. So we compute the averages. So the summary, we have the average here, residual income, and then return on investment. Return on investments. So we have project A. So for residual income in project A, we will take 180 plus 540 plus 900 plus 1260. We divide that by 4. And then for the return, it will be 20.25 plus 27 plus 40.5 plus 81. You divide by 4. The residual income for the first one, what have you gotten? 720. The return on investments, 42.1875. Thanks. So do the same now for project B. Do the same for project B and give me the answer. So these are the one. What have you gotten? 201.5. These are the one. 0.845%. 45%. So the question had asked us now, using the average residual income method of project evaluation, advise the management on the project to select. So the advice so using residual income method, using residual income method, select project A since it has a higher average. It has a higher average value. It has a higher average value. Now, determining the average return on investment, advise the management, again, using return on investment method, select project A since it has a higher average value. Has a higher average value. So just a minute. So if we are okay with that, let's proceed. And what you can see is that this is exactly what we have been doing in class. Let us now go to question number 2. Question number 2. So question number 2 says, I write 4 limitations of running curve theory as a tool for cost estimation and forecasting. So part A, limitations of running curve. Running curve method. So there are many factors or many assumptions that we gave of a running curve. And by and large, we say it becomes a limitation if that assumption does not apply in reality. So we will just cite those ones, and that would be good enough. Number one, it assumes a constant rate of running. It assumes a constant rate of running. Rate of running, first. That's the assumption. Then we have to add something to show that it's a weakness. This may not always be constant. This may not always be constant. Number two, accurate and appropriate data. Accurate and appropriate data may be difficult to estimate. May be difficult to estimate. Another one. The employees need to be motivated. The employees need to be motivated and agree to the plan. And agree to the plan. Which may not always be possible. Which may not always be possible. Not always be possible. Another one is that the stable conditions necessary for the running curve to take place, the stable conditions necessary for the running curve to take place may not be present. May not be present. Another one is that it may be difficult to estimate the initial. It may be difficult to estimate the initial time required for the very first unit. The initial time required for the very first unit. For the very first unit. Yeah, so that is a set of the assumptions, the limitations. And I have been saying anything that has an assumption, those are the weaknesses. So what you're supposed to do is to state the assumption and then go ahead and tell us that this assumption may be violated in reality. And upon violation, that becomes a weakness because it means that what was supposed to be achieved will not be achieved. Good. We go to part B of the question. Maybe now we can ask Sylvia to read for us.
Manufacturing and markets of automatic dishwashing machines. Among the components which it purchases each year from some suppliers for assembly and distribution category, and units of which it uses 20,000 units per annum. It is considered buying in bulk in order to claim monetary stocks. This will lower the number of orders placed, purchased, administrative and other costs, placing and receiving orders. The difference of actual and expected ordering costs and carrying costs are even below. Examining the actual and proposed ordering cost per order, purchase cost per items, having noted quoting cost as a percentage 10% comes into the operation. Operation tax rate is 30%. Determine the change in the EOQ caused by the new system. Then calculate the payback periods for the proposal and implemental results. Apply any two limitations of the payback periods applied in above.
Thank you, that's good. So in this case now, that is the EOQ model. EOQ model. So first of all, let's get economic order quantity. Economic order quantity. So first of all, we know that EOQ is given as 2RS. You divide by H, you get the square root. Get the square root. So let's start with action. We start with actual. When we start with actual, I think everything is well illustrated or given. The EOQ will be 2 times R. R is the annual demand. Annual demand is what? 20,000. 20,000 times S. S is the the fixed cost per order. The fixed cost per order is what? That 1.25. You divide by the holding cost. Holding cost, the percentage is 20%. 20% of the purchase. The purchase, each unit is being purchased at 6.25. 6.25. You have 1,000 units. All right, so with that, let's get the proposed. The EOQ will be 2 times the annual demand remains, but now here they are proposing that the ordering cost will be 120. 120. You divide by, in the proposal, the cost of capital still remains 20% of the purchase is 6 bob. The purchase is 6 bob. 2,000 units. 2,000 units. So the question was the change. The question was the change is that units ordered will double in the proposed system. In the proposed system. Okay. So the question is asking us to compute the payback period. How do you compute the payback period? So payback period, how is it computed from FM? How do you go about it? It is the initial cost. You divide by annual savings. Annual savings. Annual savings or annual profits or whatever you call it. In a firm, they could have different terms to measure that. So what we need to do is to get the costs, whereby we know that total costs is given as R times C plus R out of Q times S plus Q out of 2 times H. So let's look at the actual. The actual total cost will be 20,000 times C, which is 6.25, plus 20,000, you divide by Q, which is 1,000, multiplied by S, which is that 1.25, plus 1,000, you divide by 2, multiplied by H. H is 0.2 of 6.25. 6.25. What do you have? Huh? Let's come to the proposed. Total cost will be 20,000 times 6 plus 20,000 divide by 2,000 times 120 plus 2,000 you divide by 2 times 0.2 times 6. $122,400. So the savings, so the annual savings, will be equal to 126,250 minus 124,400. That is Kenya shillings. $38.50. So the payback period then should be equal to, the project was costing 10,000. That's it. It was costing 10,000. You divide by 38.50. $2.6 years. $2.6 years. You agree with that? Tuko sawa? Good. Kama tuko sawa, we go now to question number 3. Yeah? Oh, there is a part, whatever. He's saying we do what? Comment on your results. What do you think? What can you say? You can say that the payback period is reasonable. See, that is roughly 3 years. Yeah, it is reasonable. The payback period is reasonable. And therefore, the project should be rather, and therefore the company should implement a new arrangement. The payback period is reasonable, therefore the company should implement the new arrangement. New arrangements. Limitations of payback period method. You should be professors in that. Ndio mnafanya advanced financial management. But for the interest of those who tell me not everyone is doing AFM, let me read one or two. One is that it does not consider time value of money. It does not consider time value of money. It does not consider time value of money. Yes, Adam, good, can see that. It ignores the time value of money. Number two, it does not consider the inflows after the payback period. Does not consider the inflows after the payback period. Another one is that no standardized way of determining acceptable payback periods. Of determining acceptable payback period. Payback period. Yeah, so how do you know that 3 years is good, 10 years is not good, or it's good? So it's very subjective, and that makes it weak. Good. We can now proceed to question number 3 and ask Jane to read for us.
The current sales are direct to retailers, but in recent years, there has been a steady decline in output because of increased competition. The last year's trading year, 2020, the accounting period indicated that the company reported the lowest profit for the last 10 years. The focus for 2021 indicates that the present deterioration in profits is likely to continue. The company considers that a profit of 8 million achieved to provide adequate return on capital. The managing director has asked that a review be made for the present pricing and marketing policies. The marketing director has completed the list review and passes the proposals to you for evaluation and recommendation, together with the profit and loss account for the year ended at 1st December 2020. So now the information to be submitted to the managing director includes the following proposals. One, to proceed on the basis of the analysis of the market research studies, which indicates that demand for the jumpers is such that 10% reduction in selling price would increase demand by 40%. Two, to proceed with the inquiry that the marketing director has had from a mail order company about the possibility for purchasing 50,000 units annually if the selling price is right. The main order that will transport the jumpers from Surrey Limited to its own warehouse. No sales commission paid on these sales by Surrey Limited. However, if an acceptable price can be negotiated, Surrey Limited will be expected to contribute 6 million per annum towards the cost of producing the mail order catalog. It would also be necessary for Surrey Limited to provide special additional packaging at a cost of 50 shillings per jumper. The marketing director considers that in 2021, the sales from existing business will remain unchanged at 100,000 jumpers based on a selling price of 1,000 per jumper if the main order contract is undertaken. 3. To proceed on the basis of a review by marketing director at a 10% price reduction together with the national advertising campaign costing 3 million may increase sales to the maximum capacity of 60,000 jumpers. 1. Required determine the break-even sales value based on 2020 accounts.
Thank you, that's good. We can begin from there. The break-even points. That is now question number 3. Break-even points. So we can get XBE is given as F divided by contribution margin. F divided by contribution margin. So according to the current proposal, or the current situation, F, that is the fixed cost. If you look at this statement for the year 2020, and follow the factory cost of goods sold, we have materials, labor, variable overheads, and then we have fixed factory overheads of 22 million. 22 million, that is fixed. Then we have administration overheads, those are also fixed, 14 million. Then we have the selling. Now selling is a variable cost because you can see it is 2% of sales. Delivery cost, we have the variable and then we have the fixed. The fixed is 4 million. So that gives us Kenya shillings. How much? $40 million. $40 million. The next thing is contribution margin. And contribution margin we know is given as selling price minus variable costs. Selling price minus variable cost. So selling price is that we will get revenue over the units, and the revenue is 100 million. Now this one you divide by the units. It is actually even given. it is actually given as Kenya shillings 1,000. That is already given. Then V, the variable cost per unit. The variable cost per unit. We will take the direct materials of 10 million plus the direct labor of 35 million plus the variable of 6 million. That is the variable overheads. Then 20 for sales commission of 2 million. And then we go to the delivery cost of 5 million. Delivery cost of 5 million. So now these ones, it is the total. Those are the total. So you divide by the units, 100,000 jumpers, 100,000 jumpers, so that we get to know what is the variable cost per jumper. Variable cost per jumper, unapata ngapi? 580. Yes, Adam, see 580 also. So the contribution margin will be 1,000 minus 580, which is Kenya shillings 420. So the break-even point in units, the break-even point units is the 40 million. You divide by 420. What do you have? 95? To that age, exact. 0.09. So we can make it 95 to that 9 units. So I think that was the answer. The sales value. So in case they wanted in shillings, in case they wanted in shillings, you can come here and say contribution margin ratio is given as contribution margin we divide by price. Contribution margin we divide by the price. So this is 420, you divide by the price of 1,000, that gives you 0.42. 0.42. So our RBE is usually given as F out of contribution margin ratio. F divided by contribution margin ratio. So this becomes 40 million divided by 0.42. How many millions? 95 million, 238, 095. Points, 0.24. Okay, so we go to the next one. The next question says that a financial evaluation of proposal 1 above and computation of the number of units they would require to sell to earn a target profit of 8 million. Right now, the company is earning 2 million. The profit currently is 2 million. So let's evaluate proposal 1 and see what it has. Now, proposal 1, the question says that to proceed on the basis of analysis of market research studies, which indicate that demand for the jumpers is such that a 10% reduction in selling price would increase demand by 40%. So let's get the new price. The new price will be equal to, currently it is 1,000. Currently it is 1,000, and we are told we reduce by 10%. So multiply by 1 minus 0.1, and that will give us Kenya shillings. Is it 900? 900. Then, and remember, this is our P, according to our workings. Then new units. New units is that currently we are selling 100,000. And we are told that the demand would go up by 40%. So plus 0.4. So that will give us what? 140,000 units. Is that so? And remember, that is our X. Remember, that is our X. So the new contribution margin will be P minus V. So our P now is 900, and our V means there will be a small change, or a small working. Earlier on, we had gotten a variable cost of what? 580. And that included everything. But now, This variable cost, remember, it changes as the unit change. As the units change. So for the materials, labor, and variable overheads, and also the delivery, those ones are not affected by the change in units because they vary per unit. But the sales commission, which is 2%, that one will be affected because the price that we used earlier was 1,000. But now the price is what? Is 900. 900. So how do we work out that? We must rest 2% of the changed price or the difference in price, which is 1,000 minus 900. To understand that. So maybe we can simplify it further here. 900 minus 580 minus, give me this, that is 20. So this will be 900 minus 560. Yeah? Yes. The answer will still be the same because variable cost changes depending on the number of units and it remains constant. The per unit is constant. So that if you had 20 divided by 4 and you got 5, if the variable is constant, and maybe you multiply here by 3 and here by 3 so that you have 60 and 12, that now will be still 5. So for the others, there is no problem because variable cost is per unit. If you look at our notes, we said it is expressed on a per unit basis. But what is changing is this one because included in these 580, it was 2% of 1,000. But now we are supposed to include 2% of what? 900. So we rest the difference. So this gives us how much? 340. That gives us 340. So we know that profit made is given as the contribution margin X minus F. We know that. So our new profit is 340 times the new number of units, which are 140,000, minus the fixed cost. The fixed cost still remains 40 million. Still remains 40 million. $7.6 million. So old profits or current profit in our, it is 2 million. It is 2 million. So increase in profits or change in profit will be 7,600,000 minus 2 million, and that will be Kenya shillings 5,600,000. So the comments I'm told this is 2, not 20. That is according to Adam. That's all. 2%. See, statement ilikuwa inasema 2%. So it is 2 shillings. So if it is 2 shillings, then here I should have raised 2. And therefore this is 578. And based on that, what we get? $322. So if it is 322, then tukibia hapa tubadilishe 322. Obviously, this one will change. $0.80. So the change in profit is 30.80. So the comment is that you can write that the proposal is better. The proposal is better. The proposal is better since it increases the profits. Since it increases the profit by 3,080,000. By 3,080,000. Sindio? By. Umesema tu. Okay, it increases by. It increases the profit by 3,080,000. So that's okay, yeah? Then you are told to get the units required to sell to add a target of 8 million. So X target, we said it is the profit target plus the fixed cost divided by contribution margin. Divide by contribution margin. So we are targeting 8 million. And the fixed cost is 40 million. And the contribution margin is 322. 1. 0.69 exactly. Around it. Okay. Let us proceed now to propose. Proposal 2. So proposal 2, we are told, advise the management of Soli Limited on the minimum prices that would have to be quoted to the mail order company to ensure that Soli Limited would at least break even on the mail order contract. On the mail order contract. So we can try to see what is on the basis of the proposal 3. We need proposal 2. We can just present it like an income statement. Proposal 2 income statement. Proposal 2 income statements. And in this income statement, we are just going to deal with the incrementals. We're just going to deal with the incremental. This is a case of special pricing. It's a case of special pricing decision. It's a case of special pricing decision. When we say special pricing decision, you go by the variable cost. Go by the variable cost. So let's start with direct materials costs. Direct materials costs. Direct materials costs. According to the current one, according to the current one, the direct material costs is 10 million. And you see that, the 10,000. Now this one, you divide by 100 jumpers. If the figures are in thousands, if our figures are in thousands, then you multiply by 50. You multiply by 50 jumpers according to this proposal. How much is that? $5,000. 5,000. Then we go to direct labor. Huh? Just 5. To 10 million.
And then you raise it to the 3 zeros.
This one, this way. So 3 zeros give me 5,000. Huh? 5,000 or 5 million. Yes, see, because my figures are in thousands. Because sawa sana. Iko sawa sana. Acha tufanye. Iko sawa sana. Kwa namna hii. 10 million you divide by 100,000 times 50,000 jumpers. That is the one that is giving us what? 5 million. See there? Yes. Put the figures in the calculator. Direct labor costs. Huh? 5,000 shillings on. Even after I put this. Okay. Come on, so now we go to direct labor. Direct labor is that 5 million. You divide by 100,000, multiply by 50,000. Multiply by 50,000. You get? Huh? Acha imekaribia. Ishafika. Network imeanza kupotea Hii ni 350 times 50,000. 17,500,000. 17,500,000. Haya, tuende kwa variable overheads. Variable overhead costs. Variable overhead cost is 6 million. You divide by 100,000 times 50,000. $3 million. Then the fixed, those ones are not changed. Because you can see this guy is saying the marketing director considers that the sales from the existing would remain unchanged at 100,000 based on the selling price of 1,000 per jumper in the mail order contract is undertaken. And there is nowhere we are told that there will be a change of capacity. So the fixed costs will remain. So the fixed overhead of 22, we are not going to touch. And remember, when we are computing the minimum cost, the minimum price, or the minimum cost, we don't include the fixed cost. Then for the admin, given that one, we shall not include. For the selling and distribution, the sales commission, there is somewhere they had said, the mail order company would transport the jumpers from Solid Limited to its own warehouse, and no sales commission would be paid on these sales. So we are not going to pay any sales commission. Yeah. Then after delivery. However, if an acceptable price can be negotiated, Solid Limited will be expected to contribute sharing 6 million per annum towards the cost of producing the mail order catalog. So that is a relevant cost. It's a fixed cost, but a relevant cost. So catalog production costs. Production costs is 6 million. Is 6 million. Then it would also be necessary for Solid Limited to provide special additional packaging at a cost of 50 per jump. So packaging costs, it is 50 per jumper. So 50 times 50,000. That gives us what? 2.5 million. $225,000. Those are effects of jam. I'm going to choke. But I want to finish the question so that next time we start a fresh one. Sasa, then they say the marketing director, sales remain. So see, that is all. Because the delivery, whatever, that one remains. Okay. So with that now, yes, that one will not change because it will be necessary to provide special additional. Where are they talking about? The mail company, the mail order company will transport the jumpers from Solid to its own warehouse, and no sales will be paid. However, if an acceptable, it would also be necessary to provide special additional packaging. The marketing director, I don't think the delivery will be there because these guys will transport. These guys will transport the goods to their warehouses. Yeah. So if they are going to transport, we don't need that cost. So the marginal costs. We're getting how much? 34 million. So therefore, the minimum price per jumper should be 34 million. You divide by 50,000. You have 608. So that is the minimum price that these guys should pay. Then part D is financial evaluation of proposal 3. Is that what it's saying? So proposal 3. So proposal 3 we are told to proceed on the basis of the view by the marketing director that 10% price reduction together with national. Okay, so price will be 1,000 times 1 minus 0.1. That is Kenya shillings 900. So that one is exactly like what we have done with proposal. Was it 2? 1, where we had gotten that the contribution margin was price minus variable cost, which was 900 minus equal what? 578. 578, which gave us Kenya shillings 322. 322. So the profit, which is given as contribution margin X minus F, X minus F, it will be 322, and this is applied for the whole number of units. That is 160,000. Then the fixed cost will still remain at 40. The fixed cost will still remain at 40. But now we are told that we will have to do what? To incur an extra what? 3 million. To incur an extra 3 million. Huh? 95.20. 85.20. 85.20. So increase in profits. Increase in profits will be 85,20,000 minus the current 2 million. So that will be Kenya shillings 6,520,000. So proposal 3 is giving us an incremental profit of so is that okay? So we then call it a day at that juncture and pick up from there in the next lesson. Thank you.